JEPI's 60% return crushes PULS's 21% over 5 years. That's a $39,000 difference on every 100 grand you invest here. Let's dig into the details. JEPI crushed it with 60% gains, while PULS barely moved at 21%. That's not a close race at all. Now, let's shift gears and look at JEPI's pulling ahead with a 9% return versus PULS's 5%, nearly double the performance over 12 months. Here's where it gets interesting. PULS returned just 5% over the year, falling further behind competitors across every time frame we're tracking here. In plain English, JEPI's 60% total return left PULS in the dust at just 21% over 5 years. Think race cars, same track, same conditions, but one's got the horsepower and the other's struggling to keep pace. JEPI nearly doubled PULS's performance over 3 years, 34% versus 18%. That's a massive gap you can't ignore when picking income funds. JEPI dominates PULS across every time frame shown here, 1, 3, and 5 years. That's consistency you can't ignore. Let's break this down further. Returns alone don't tell you if you're taking a wild ride to get there. Let's see who delivers smarter gains. In plain English, think of risk-adjusted returns like racing athletes. One sprints faster but burns out quickly. The Sharpe ratio measures who wins more efficiently for the energy spent. It's about sustainable performance. Now for the real question. JEPI's Sharpe ratio of 0.6 means you're getting decent returns without taking on crazy amounts of risk. Pretty solid balance here. Here's where things get revealing. PULS's 0.3 Sharpe ratio is rough. JEPI doubles that efficiency, meaning you're getting twice the return per unit of risk. Now, let's put this in perspective. A 2.6 Sharpe ratio is exceptional. PULS delivered strong returns with remarkably low volatility over the past year. But wait, there's more to this story. JEPI's 0.4 Sharpe ratio is pretty underwhelming. PULS crushed it with 6 times better risk-adjusted performance over the same period. In plain English, here's the seesaw in action. JEPI rode high over 5 years with better risk-adjusted returns, but PULS recently flipped the balance, delivering smoother gains with less volatility. Let's take a closer look. Sortino ignores upside swings. It only cares about downside drops, which is what really keeps retirees up at night. Now here's where it gets tricky. JEPI's 0.7 Sortino ratio shows it's protecting your downside pretty well while still delivering returns. Decent risk management here. But that's not the whole picture. PULS's Sortino ratio of 0.2 tells us the returns barely justified the downside risk investors actually faced over 5 years. In plain English, the Sortino ratio is like watching a storm brew. You only count the bad weather days. JEPI earned more return per bad day than PULS, making it the better shelter when markets get rough. Here's what really matters. Now let's talk worst-case scenarios, how badly things can drop, and how long you'll wait to recover your losses. Now, let's connect the dots. A 14% drawdown is pretty gentle for stocks. You'll barely feel that drop compared to what typical equity funds experience. But hold on a second. PULS barely budged during its worst stretch. Just a 0.79% drop proves this fund is rock-solid steady. In plain English, maximum drawdown shows you the worst drop from peak to valley. Think of it like a roller coaster. JEPI plunged 14%, while PULS barely dipped at all. Completely different risk profiles. All right, pause here. Who's your pick? JEPI or PULS? Drop your vote in the comments. Now let's flip the script. Nearly 9 months underwater. That's how long you'd wait just to break even after JEPI's worst drop. But there's a catch. 3 weeks to bounce back. PULS didn't mess around when recovering from its drawdown, showing real resilience when it mattered most. In plain English, JEPI took 9 months to recover while PULS bounced back in just 3 weeks. Think of it like a balloon deflating. Some reinflate fast, others stay flat when you need them most. Let's dig into the details. Dividend yield matters most when you're retired and living off your portfolio's cash flow every single year. Let's dig into the details. JEPI's 8% yield means $100,000 invested generates $8,000 annually. That's serious income without selling shares. Here's where it gets interesting. PULS delivers a solid 4.8% dividend yield. That's $4,800 annually on a $100,000 investment, beating most bonds easily. In plain English, think of dividend yield like couch change adding up each month. JEPI drops $667, while PULS gives you $400. Same piggy bank concept, just different amounts hitting your account regularly. Here's where things get revealing. Dividend growth matters because negative growth means your income's shrinking while inflation eats away at your purchasing power every year. Here's where the story takes a turn. Your JEPI income is shrinking, not growing. That negative 0.8% 3-year dividend growth means your paycheck's getting smaller every year. Let's break this down further. PULS's negative 3.8% dividend growth means your income's shrinking every year. That's an accelerating decline you can't ignore. In plain English, think of this as your retirement report card getting worse every semester. Both funds are cutting dividend payments year after year, leaving retirees' income shrinking while inflation keeps climbing. Now, for the real question. JEPI delivers higher returns at 60% and double the dividend at 8%, but you'll face a brutal 14% drop and nearly 9 months to recover. PULS trades growth for stability. So there you have it. JEPI gives you growth potential, while PULS keeps things steady when markets get choppy. Now, let's put this in perspective. JEPI tracks the market incredibly closely. That 0.9 correlation means it's barely different from owning SPY itself most days. But wait, there's more to this story. PULS moves independently from the stock market. That 0.1 correlation means it's not dancing to SPY's tune at all. In plain English, think of JEPI and PULS as dance partners with totally different styles. JEPI moves with the market's rhythm, mirroring every stock move. PULS, it's dancing solo, completely ignoring what stocks do. Let's take a closer look. Beta measures how much your fund moves when the market moves. 1.0 means they're dancing in perfect sync together. Now here's where it gets tricky. JEPI's 0.6 beta means it captures just 60% of market swings. You'll gain less in rallies, but lose less in crashes. But that's not the whole picture. PULS shows 0 beta over 5 years, meaning it moves completely independently from the stock market's ups and downs. In plain English, beta's your amplifier knob for market swings. JEPI's dialed to 60% volume. You'll feel market moves, but they're dampened. PULS? Completely muted. It's like comparing a sports car to a parked minivan. Totally different risk profiles. Here's what really matters. Fees you're paying today aren't just costs. They're stealing your future compounding gains, so lower expenses directly boost your long-term wealth. Now, let's connect the dots. JEPI's 0.35% expense ratio costs you $350 yearly on every $100,000 invested, higher than most passive funds you'll find. But hold on a second. PULS keeps more of your money. At 0.15%, you're saving $200 annually compared to JEPI's higher fees. In plain English, think of expense ratios as couch change. You're losing every year. JEPI costs you $350 annually, while PULS only costs $150. That $200 difference? It compounds into serious money over decades. Here's the key takeaway. For retirees, lower volatility isn't just about numbers. It's about sleeping soundly and not panicking when markets drop hard. Now, let's flip the script. JEPI's 11% volatility is remarkably tame. You're getting equity exposure with significantly less drama than most stock funds. Now, let's put this in perspective. PULS shows just 0.7% volatility over 5 years. That's remarkably stable for an equity investment, almost resembling bond-like consistency. In plain English, here's the stormy ocean versus calm pool. JEPI rocks you with 11% volatility waves, while PULS barely ripples at 0.7%. Completely different rides for your portfolio. Now, let's shift gears and look at best year returns, show you how high these funds can climb when everything's working perfectly. That's your upside potential right there. Let's dig into the details. JEPI's best year hit 22%. That's solid upside for an income fund that's focused on steady distributions, not growth. Here's where it gets interesting. PULS's best year delivered just 6%. That's the trade-off when you're playing it safe with low volatility investments. In plain English, think of it like a finish line. JEPI sprints to 22% in strong markets, while PULS jogs to 6%. You're trading safety for speed. Lower risk caps your upside potential. We're comparing two completely different approaches here. Equity income with covered calls versus ultra short-term bonds. Let's see how they stack up. Here's where the story takes a turn. JEPI lets you chase stock market gains while collecting option income, but you're still riding the full equity roller coaster here. Let's break this down further. PULS is all about keeping your money safe. You'll miss out on big gains, but you'll sleep well at night. In plain English, JEPI's chasing growth with everything in equities. Classic high-reward bet. PULS, they're playing it safe, spreading risk across baskets. Two totally different games, two different egg basket philosophies here. Now for the real question. JEPI brings you growth with income. While PULS keeps things stable for cash management, they're built for completely different jobs in your portfolio. Here's where things get revealing. JEPI's sweet spot. You're getting equity growth potential plus strong dividends with volatility that's tolerable for most income-focused investors. Now let's put this in perspective. PULS is your parking spot for cash, stable, safe, and earning yield while you wait for better opportunities elsewhere. In plain English, think of your portfolio like a building crumbling without proper support. JEPI generates income as your growth floor, while PULS provides the stable foundation. You need both working together for a structure that won't collapse. Here's the thing, though. Your timeline completely flips the winner. JEPI's 60% crushes long-term, while PULS protects short-term with minimal downside risk. Let's take a closer look. JEPI's 14% drawdown and 258-day recovery demands guts, but rewards you. PULS, stability for those who need peaceful nights. Now here's where it gets tricky. JEPI's 8% yield versus PULS's 4.8%. It's the classic trade-off between chasing income now or prioritizing capital protection first. In plain English, here's the perfect analogy for choosing your ETF. JEPI's built for those chasing long-term growth like a marathon runner, while PULS offers steady, comfortable income. Match the investment to your actual financial journey. Let's see how this plays out. JEPI's built for moderate risk takers hunting income over 10+ years, while PULS suits conservative investors preserving capital short-term. In plain English, here's who these funds are built for. JEPI's your marathon runner, ready to handle market swings and volatility. PULS, that's your couch sitter, prioritizing safety and stability over the bumpy ride. Now let's connect the dots. Standard disclaimer here. Do your own research and consult professionals before investing. But hold on a second. If you enjoyed this ETF breakdown, hit subscribe for weekly fund battles packed with data-driven insights you can actually use.